Our next guest has been correctly betting on a Treasury rally since early spring. Yields, as you know, at 2.5% for the 10-year. George Goncalves, head of U.S. rate strategy at Nomura, joining us now to discuss why he believes the bond market is entering the final stages of the rally. George, always glad to have you in with us. Thanks for stopping by. So you were out ahead of the pack. You were on with us about 9 months ago. You said the yield curve would continue to flatten. I'm not going to say you were the only one with that call, but certainly you were in a few number making such a bold call. Now you say the Treasury rally is winding down. Why do you think so?
Well, we finally have gotten to a point where we're in the capitulation phase, where a lot of investors that were against the bond market are now in favor of the bond market and thinking that it's really the only game in town. And we think that once you see, the guys that were very bearish become either neutral or bond bullish, we're getting to the last stages of the rally. This denial till acceptance phase, that's what we're in right now. Everyone was in denial that bond yields couldn't rally and the market couldn't rally further.
Because 9 months ago, there were people saying that treasuries were overbought.
Correct.
And obviously you went ahead. You said, no, it's not true. We're going to see flattening. But what do you think the Fed is going to do? In other words, do you think the bond market is too pessimistic, given that we've heard a lot of people say, look, QE2 is coming as early as even the end of this month or the beginning of next month? What is that going to do to the bond market if it comes?
It all depends on how the QE2 is structured. I think that the Fed will now treat QE2 in the same vein as it did in the past for easing with the Fed funds rate. So it will be incremental. It will increase money into the system, buying treasuries perhaps, maybe buying other asset classes to really get the juices flowing. But I think betting specifically on QE2, given how low rates are right now, a lot of the move is behind us. And now you have to be nimble, and trying to be an investor in a trader's market, in the bond market, especially in the belly of the curve, is very difficult right now.
But as part of your premise, in other words, if the Fed for some reason doesn't launch that second round of quantitative easing, does your premise hold up?
I think so. I think we're in a pause that will refresh. And what I mean by that is we've gone to extremely low yield levels. We moved over 140 basis points in the 10-year note. I think we're now at a point where it makes sense to take some profits, slowly peeling back any gains that you do have in your bond portfolio, but keeping some in there just in case the Fed does QE2, or if problems out of Europe, or if the stock market were to fall further. But I would not be adding more, is what's really the big difference in our opinion.
So right now you're just saying, look, the bond market is too pessimistic. The bond market is pricing in sort of hell in a handbasket, and you're not necessarily seeing a double-dip recession either.
That's not our call. We think that we're going to definitely have GDP momentum continue to slow. We're going to find out on Friday more on that regard. And going into the third quarter, there's the risk that we get into very low 1% on the third quarter number for GDP. But a double dip at this point, I think, is a little bit too premature. A lot of the bad news is priced in. If you look at yesterday's reaction to the bond market, to the horrendous housing data, we actually had a nice rally and then gave it all back. I think that the market is under a buyer exhaustion. A lot of buying has taken place at very low yield levels, and people are trying to draw the line in the sand.
George, is the most important thing that the Fed can do right now just buy time?
That's a good point, and I think that's what they're trying to do. By them going to this new QE light, which Nomura and our economists, Zach Pandel and David Ressler, were one of the few to come out and suggest that at the August 10th meeting there was going to be an easing, and we've had that. They're buying time to figure out how bad is the economic data, how much worse can it get, will it stabilize, and what kind of backdrop will the risk markets have. That all that data will be collected into the September meeting, at which point maybe they will do more QE if things get worse from here. But a lot of it's been priced into the market, at least into the bond market.
All right, George, thanks so much for coming in. Congratulations on that call, that 9-month call right here on our program. That was right. George Goncalves joining us there from Nomura.